Normally, hardware is just a terrible business to be in.
Oh, absolutely brutal.
Right. I mean, you build a microchip, someone else figures out how to copy it, prices crash, and then everyone races to the bottom just to survive.
Yeah, it's historically a very low margin grind.
But today, we are looking at a hardware company that just posted an 86% profit margin.
Which is just, well, it's insane.
It is. Those are numbers you usually reserve for, like luxury software or high-end fashion.
Yeah.
Definitely not physical silicon.
No, definitely not.
So today, in this deep dive, we're looking at how Micron technology just broke every rule of Wall Street physics. And really, what it means for you if you're trying to understand the future of the artificial intelligence boom.
Because it genuinely defies the entire historical framework of the semiconductor industry. I mean, when you look at the raw data from their fiscal Q3 2026 earnings report that came out today, June 24th, you aren't just seeing a company beating expectations.
Right.
You are seeing a fundamental shift in how global tech infrastructure is actually being funded and built.
So let's put some hard numbers to that shift, because the scale here is just, it's tough to wrap your head around.
Really is.
For fiscal Q3, Micron's top-line revenue hit $41.46 billion.
Wow.
Yeah. And the smartest analysts on Wall Street had modeled around $35.59 billion.
Right.
So they blew past consensus by nearly $6 billion in a single 90-day window. And just a year ago, in this exact same quarter, they reported $9.30 billion.
And we have to ground that explosion in pure profitability, you know?
Yeah, the bottom line.
Exactly. The top line is massive, but the bottom line is what sent shockwaves through the market today. Their non-GAAP net income for the quarter was $28.86 billion.
That's just wild.
In per-share terms, that's an adjusted earnings per share of $25.11.
And Wall Street had estimated, what, around $20?
Yeah, exactly 20. So they smashed profitability models by over 22%.
Wait, I have to stop and push back on that for a second.
Sure.
You just said revenue basically quadrupled year over year.
Yeah, near fourfold increase.
Historically, when a manufacturing company tries to scale production that fast, especially something as complex as microscopic memory chips, their operational costs just skyrocket.
Oh, usually, yeah. They have to run factories over time.
Right. Yields drop and margins get completely crushed. So did they just spend an absolute fortune to make this $41 billion?
I mean, that is the logical assumption based on past hardware cycles, but that is the exact opposite of what happened here. Let's look at the adjusted gross margin for the quarter.
Okay.
It came in at 84.9%.
Unbelievable.
And their guidance for the upcoming quarter is approximately 86%. So they didn't crush their margins to scale. They expanded them to levels we have literally never seen in this sector.
So to hit 86% margins on a physical product, I mean, I can only think of one way that works.
How's that?
If the entire AI industry right now is a gold rush, Micron isn't just selling the pickaxes. They somehow managed to buy the only toll road leading to the gold mine.
I like that.
And they're charging literally whatever they want to let people through.
The toll road is, it's the perfect way to look at it. An 86% margin signals unprecedented absolute pricing power.
Because everyone needs it.
Exactly. What is happening in the physical world is that demand for advanced memory is vastly outstripping the entire industry's capacity to fabricate it. The buyers here are the massive hyperscalers, right?
Oh, Google, Microsoft, Amazon.
Right. And usually those giants have all the leverage. They dictate the terms.
They usually squeeze the hardware guys dry.
Exactly. But right now, they have zero leverage. Memory has shifted from a basic interchangeable commodity to a highly constrained strategic asset. If you want to build $1 billion AI data center, well, you pay the toll.
An 86% margin means those buyers are truly desperate. But what physical bottleneck are these hyperscalers trying to solve that makes them willing to pay literally any price Micron asks?
It comes down to architecture.
Like, what is actually happening inside these data centers?
Well, we need to translate the technology to understand the desperation.
Yeah.
Think of the newest AI processors, the GPUs, as incredibly massive, thirsty V12 engines.
Okay, well, I'm with you.
They can process billions of calculations a second. But if the fuel pump, which in this case is the memory, can only drip data through a tiny coffee straw, the engine's power is completely useless.
It just sits there idling.
Right. It sits there waiting for data. What Micron is providing is essentially a fire hose installed directly into the combustion chamber. That fire hose is called high bandwidth memory, or HBM.
The sources mention they are shipping massive volumes of something called HBM4 12 high, built on a 1 beta DRAM node.
Yeah, that's the one.
Let's translate that alphabet soup into plain English because it sounds like a major engineering feat.
It is a staggering achievement in physics, honestly. 12 high means they're literally stacking 12 microscopic layers of silicon memory directly on top of each other.
Like a skyscraper.
Exactly like a high-rise skyscraper. And to get the data to flow, they punch microscopic wires called through silicon via straight down through all 12 floors of the chips.
So instead of spreading the memory out flat on a motherboard like we used to, they build vertically.
Exactly. It is 3D real estate for silicon. And the reason they do this is literally the speed of light.
Wait, really?
Yeah. The shorter the physical distance between the memory skyscraper and the AI processor, the faster it can feed data. Micron's HBM4 is tracking twice as fast in its volume ramp as the previous generation.
That's huge.
And it has already generated over $1 billion in revenue just from their lead customer. Plus, they are already developing the next generation, HBM4E, on their new 1 gamma node, aiming for production in 2027.
Okay, so the HBM is the fire hose sitting right next to the processor. But a data center isn't just one processor.
No, not all.
You have thousands of servers networked together. You need data moving at light speed across the entire facility.
And that requires massive data pipes everywhere else in the server rack. Micron is supplying those too. They are currently shipping 256 gigabyte DDR5 memory modules to server partners.
Right.
But the really critical piece of the puzzle is long-term storage. The solid-state drives, or SSDs, they highlighted massive rollouts of their new generation of high-performance SSDs, like the PCIe Gen 6 drives.
The 9650 and the 6600 ION.
Right, you got it.
The technical specs on those Gen 6 drives noted that they double the sequential read throughput. So they're basically twice as fast as the old drives.
Yep.
But the sources also emphasize that they maintain a strict 25-watt power envelope. Why does that specific wattage matter so much to a trillion-dollar hyperscaler?
Because power and cooling are the ultimate physical limits of the AI revolution right now.
Ah, okay.
If you double the speed of an SSD, but you also double its power draw, that drive generates twice as much heat.
Yeah, multiply that by 10,000 drives in a server hall.
Exactly, and the entire facility literally melts. AI data centers are currently hitting the absolute limits of the local electrical grids. Bringing double the speed at the exact same 25-watt power footprint is the only way these hyperscalers can actually plug these new drives in without redesigning their entire cooling infrastructure.
That makes total sense.
Yeah.
I mean, you can have all the compute in the world, but if you can't cool the building, you're dead in the water.
Right.
So they are dominating the data center with these hyper-efficient drives and colossal 245 terabyte storage drives for training data.
Yeah, massive capacity.
But looking at the revenue breakdown, I noticed something that challenges the idea that this is strictly a data center story.
Oh, the mobile numbers.
Yes, cloud memory brought in $13.77 billion at an 83% margin. Core data center hit $11.52 billion at an 87% margin.
Huge numbers.
But then the mobile and client unit, which covers smartphones and laptops, also printed a clean $11.52 billion.
Matching the data center.
Exactly, matching it. And also sitting at an 87% margin. Why do phones suddenly need data center level memory margins?
That is the ripple effect of the AI boom. We are entering the era of agentic AI.
Meaning AI that takes actions for you.
Precisely. Artificial intelligence that can actually take complex actions on your behalf rather than just answering questions in a chat box. And consumers want that AI running locally on their phones and laptops.
For privacy and zero latency speed, I assume.
Right. So instead of the phone sending a request to the cloud and waiting for an answer, the phone itself has to hold the entire AI model in its active memory.
Oh, well. Running a large language model locally on a smartphone must require vastly more memory than traditional apps.
It completely drains the phone's resources. So Micron is ramping up highly advanced power-efficient memory, their 1 gamma LPDDR5X, specifically for leading smartphone manufacturers.
So it's everywhere.
Yes. The demand shock isn't isolated to server farms. It is hitting every single vertical simultaneously, from the cloud down to the device in your pocket.
I hear the mechanics of this, and the technological dominance is super clear. But let me play devil's advocate for a minute.
Sure, go for it.
Because in our research for this deep dive, we reviewed a very vocal bear case. There was an analysis from 247 Wall Street that actually slapped a sell rating on Micron.
Right, with a price target of $731.
Yeah, which is significantly below where the stock is trading right now. Their argument is essentially, look, we've seen this movie before.
The cyclicality argument.
Exactly. The memory market is a notoriously brutal boom and bust cycle. Right now, with the stock trading at 53 times trailing earnings and margins at 86%, they argue we are at the absolute peak of the cycle.
That's the traditional view, yeah.
They say when the cycle normalizes, margins will compress, demand will soften, and the floor will just fall out. They even pointed out that CEO Sanjay Mehrotra has been selling shares.
Right.
How do we reconcile this historic $41 billion quarter with the very real history of memory markets eventually collapsing?
Well, the bears are relying on historical models of cyclicality, which, makes sense if you look at the last 30 years of semiconductor history.
It's always been a roller coaster.
Always. During a boom, memory companies would overbuild their fabrication plants. By the time the plants were finished, demand would soften, the market would flood with excess chips, and prices would crash.
Right, the classic bust.
But Micron just introduced a structural change to their business that completely detonates that old model. It's what management is calling strategic customer agreements, or SCAs.
Let's dig into these SCAs because the financial structures here seem completely unprecedented for hardware.
They really are.
Assuming our listeners know the basics of a corporate contract, what makes these agreements so different?
It's the scale and the binding nature of them. Micron announced they have signed 16 of these multi-year SCAs, locking in their biggest customers through the end of calendar 2030.
Wow, 2030.
And these are take-or-pay contracts.
Meaning, if the hyperscaler suddenly decides they don't need the memory in 2028, they still have to pay Micron for it regardless.
Yes. They secure a guaranteed minimum volume. These 16 agreements cover roughly 20% of Micron's total DRAM volume and a third of their NAND storage volume for the next several years.
That's a massive chunk of their business on lock.
And it gets more secure. 14 of those 16 SCAs include a cumulative minimum revenue floor.
A floor.
Yeah. That floor guarantees Micron approximately $100 billion in revenue over the term of the agreements based on strictly negotiated floor pricing.
So they locked in $100 billion of guaranteed revenue before they even manufacture the product.
Yep.
But the part of the cash flow statement that really stopped me in my tracks was the upfront payments.
Oh, the deposits.
Yeah. They secured $22 billion in customer commitments, and of that, $18 billion is in unrestricted upfront cash deposits.
It's just wild to see that on a balance sheet.
To put that in perspective for you listening, tech giants like Microsoft and Google are basically acting like desperate concert fans buying VIP tickets years in advance just to ensure the stadium actually gets built.
That is a phenomenal way to visualize it. These hyperscalers are so terrified of being bottlenecked by a lack of memory that they are literally fronting the cash to fund Micron's future capital expenditures.
Like their new fabs in Idaho and New York.
Exactly. Micron is building massive new fabrication plants there, and the customers are paying for the construction of those factories up front to guarantee their spot in line.
That flips the entire power dynamic of the tech industry. Usually, the hardware vendor takes on all the financial risk of building a $20 billion factory, hoping the demand is there when the doors open.
Right.
Now the world's richest software companies are acting as venture capitalists for Micron's physical infrastructure.
And that completely destroys the peak cycle argument from the bears. You just can't model this as a boom and bust commodity anymore.
No, clearly not.
When you have an ironclad $100 billion revenue floor, and your customers are pre-funding your factories, your business is functioning more like a contracted, heavily regulated utility. It gives Micron massive predictability and durability for their cash flow.
A utility that happens to print money at an 86% gross margin.
Exactly. And management noted that the floor pricing they negotiated in these contracts ensures that even in a worst-case scenario where the broader market softens, their gross margin will remain well above the peak margins of any past historical cycle.
So their downside is heavily protected.
Heavily protected.
Okay, so that establishes the floor. The downside risk that Wall Street is terrified of seems to be structurally mitigated. Let's look at the ceiling.
Let's do it.
Building on that locked-in security, they issued forward guidance for fiscal Q4 that left analysts scrambling to rewrite their spreadsheets overnight.
Yeah, the FQ4 guidance is what truly settles the macro debates. They guided FQ4 revenue to $50.0 billion, plus or minus $1 billion.
$50 billion?
Yeah, and an adjusted earnings per share of $31.00.
I mean, to put that $50 billion in context, Wall Street consensus was sitting around $43.2 billion.
Right.
So they guided nearly $7 billion higher than anyone thought physically possible. They are projecting to add the equivalent of a Fortune 500 company's entire annual revenue in a single 90-day period.
And this provides a very compelling data-driven answer to the broader cultural debate happening right now.
About the AI bubble.
Exactly. Every day, there is a new headline asking if we are in an AI bubble. People want to know if the hype has disconnected from the physical reality of what is actually being built.
Right, the fear that ChatGPT is a parlor trick and these companies are going to stop buying servers tomorrow.
But if Micron is printing a $41.5 billion today and confidently guiding to $50 billion tomorrow, the debate is settled.
It's hard to argue with those numbers.
Management explicitly stated in their remarks that they, quote, do not have line of sight as to when memory supply will be able to catch up with increasing demand.
Wow.
They are looking out beyond 2027 and seeing nothing but structural supply constraints.
They literally cannot pour concrete and build clean rooms fast enough, even with the customers handing them billions in cash up front.
So this earnings print acts as a massive green light for the entire AI infrastructure ecosystem. If Micron is selling $50 billion of memory in a single quarter, it means the GPU suppliers, the networking companies, the server creators, and the data center architects are all buying, building, and deploying at an unprecedented compounding pace.
The physical infrastructure of AI is being laid down as fast as humanly possible.
It is.
It is the foundation of everything that comes next. So let's bring all of this together.
Sure.
The core thesis we've uncovered today is that memory is no longer just a simple, interchangeable chip that gets tossed into the back of a server rack.
No, not at all.
It has evolved into the ultimate gatekeeper of the AI era. If you want to train a trillion-parameter large language model, you need the toll road. If you want a smartphone that can autonomously manage your schedule, you need the toll road.
And that leads to a rather provocative thought about the broader landscape of technology.
What's that?
Well, because of the intense physical demands and the massive capital requirements to build these chips, the memory industry has consolidated heavily over the last decade. There are really only three major players left on the leading edge of this technology globally: Micron, Samsung, and SK Hynix.
The big three.
Combined, those three companies now boast a market capitalization of roughly $4.1 trillion.
Wait, 4.1 trillion?
Yeah, that is equivalent to the entire gross domestic product of Japan. And as we just discussed with those strategic customer agreements, these three companies now hold take-or-pay power over the biggest tech monopolies in the world.
That's a crazy thought.
They dictate the terms, the pricing, and the supply. So the question you have to ask yourself as you watch this space evolve is this: who really controls the future of artificial intelligence?
Is it the software guys or the hardware guys?
Right. We spend so much time focusing on the software developers, the coding geniuses, and the foundational model creators. But will all that limitless software innovation ultimately be bottlenecked and dictated by the very few companies that physically control the silicon?
The gatekeepers.
Exactly. If the laws of physics and memory dictate what is actually possible to compute, then these three hardware companies are the true architects of the AI future.
That is a fascinating reality to leave on. The limitless software revolution is completely at the mercy of a physical silicon toll booth.
Yep.
And right now, that toll booth is operating at an 86% profit margin with a line of desperate tech giants stretching around the block until 2030.
Incredible.
We started this deep dive talking about Wall Street models breaking like delicate clockwork. Today, Micron didn't just break the clock, they funded and built an entirely new machine. Thank you for joining us as we unpack the physical reality behind the numbers. Keep questioning the financial models, keep looking to the underlying mechanics of the technology, and keep diving deep into the forces shaping our future.